Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're talking about ESPN and ESPN Plus after Disney's Q1 earnings results came out last week. So we're going to dive into some of the raw numbers and then see what we learned from the earnings call. But before we do any of that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. So, Disney reported their Q1 earnings last week, and at this point, most investors in Wall Street simply wants to know when its $71 billion deal to acquire some major 21st Century Fox assets is going to go through, because at this point, they're still waiting for some foreign territory approval before it closes. And then on top of that, everyone wants to know when Disney Plus, its new standalone streaming service that's set to take on Netflix and Amazon and soon enough Apple and AT&T, is going to launch. So that was a lot of what's going on, and we're going to get into some of that today because, as I said, Disney's future is in streaming, and they talked a lot about their new direct-to-consumer push with Disney Plus. And they said they're really going to get into way more of it on April 11th, which is their big Investors Day. And then they said they're going to detail their the plans they have, their overall goals, and then showcase some of the original content and then some of the pricing as well. But what we do know so far is that the service is going to be broken down into Disney, Pixar, Marvel, Star Wars, and eventually National Geographic. It's going to have new original programming that's specific just to the app. In this move, it might have seemed kind of like implausible even 5 years ago, and it really is going to be a game changer. But Netflix definitely saw this coming 5 years ago, and that's when they really started to ramp up their own original content, and that's why they've committed to spending billions of dollars every year to offer their own movies and TV shows, because Disney and Fox and all of these big studios are going to start to pull their content. Disney's pulling their content, which is going to cost them roughly $150 million a year in licensing revenue that they got from Netflix, but it's well worth it because their future long-term is in streaming. And it's also good to know right off the top that soon Disney's going to have 3 completely standalone streaming services. They're going to have their Disney Plus, which is the Disney-branded one with all the things we just mentioned, Pixar, Marvel, Star Wars. And then they're going to have ESPN Plus, which is already out. And then Hulu, which is going to come under their majority control once the Fox deal goes through. But before we get into any of the ESPN Plus stuff, I quickly want to talk about how Disney performed, because it's somewhat relevant just for the broader picture of what's going on with Disney. So their revenues came in slightly lower than last year, but it was relatively flat, pretty much at $15.3 billion, and it fell below Q4's 12% top line expansion, but it topped our estimates. So relatively solid quarter on the top line. And then its earnings fell 3% year over year, but it crushed Wall Street estimates. Maybe more importantly, though, in terms of their long-term outlook, they changed their 4 core business units so that's how they report their revenue. And they now have a direct-to-consumer and international business. That's going to be one unit. It's one of their 2 new divisions. And interactive media used to be housed together with consumer products, and consumer products is now joined together with what used to be parks and resorts. So there's now a parks, experiences, and consumer products unit, and then their direct-to-consumer and international division. So it makes the year-over-year comparisons pretty hard because they changed a lot of things around. So we won't really get into all of that because it doesn't really matter at this point. But going forward, it'll be huge. But in terms of their brand new division, which they reported for the first time, which is the direct-to-consumer and international revenue, that fell 1% to $918 million, and its operating loss went from $42 million in the year ago period to 136 million. And as a lot of people might guess, that big jump in cost pretty much came all from Disney Plus investments and ESPN Plus investments. And just as a little quick reminder, ESPN Plus is their standalone ESPN service that's not tied to any cable subscription or anything like that, but it's really a pared down version of ESPN. It's not offering you can't just cut your cable and then sign up for ESPN Plus and then get everything that is on ESPN. It's not like that at all, but we'll get into that in a little bit. That launched last April for $4.99 a month. And now let's get into a little bit of the details and come back to ESPN Plus. So Disney's Media Networks division, which houses ESPN and their broadcast unit, saw its revenues climb 7% to $5.91 billion. And more specifically, the broadcast revenue was up 12%. And then cable, which is housed ESPN, their revenue was up 4%. And then ESPN saw its operating income fall based on what Disney's saying was higher programming costs driven by the shift of the timing of the college football semifinal games. And this is going to happen a lot for ESPN and Disney in general when these things just come at different dates. So it's not like a huge concern that the shift in timing of these things, but pretty much on top of that, they saw some rate increases for NFL, college sports, and NBA, which they will see pretty much now going forward no matter what, because they're probably going to have to continue to pay a premium for these live sports rights, because as I talked about a million times, that is where the advertising money is going to come from, and that's really the only reason that anyone is going to subscribe to any of these services going forward, is the ability to watch these sports live. So those costs aren't going to go away, but once again, ESPN was able to charge higher affiliate costs. As I've mentioned before a bunch of times on this show, ESPN charges over $8 per subscriber to the cable and satellite providers, which is by far more than any other network. So even though they're losing subscribers due to just cord cutting in general, they're still able to charge more and more because that's just how valuable the live sports rights are for them. And on top of that, ESPN's ad revenue jumped 3%. So ESPN is clearly still valuable to Disney, and it will be for years to come because, as I've said, almost the whole time this show has been around, is that live sports will be the king of advertising and marketing for as long as they're around, because Netflix and Amazon Prime and now Disney Plus and all of these services, including Apple, are just going to attract more and more people to these non-ad supported platforms. So advertisers are going to need to find people somewhere. And so now we're going to get into a little bit of more of ESPN Plus specifics, because that's how I want to close out the show, because this is the future of Disney and the future of ESPN, not necessarily very soon, but in the long run, that is the plan. So as I mentioned, it launched in April of 2018. So we're coming up on a year. It costs $4.99 per month and $49.99 per year. So it's a better deal to get it for the year, obviously. And it doesn't have the premier content like Monday Night Football or NBA basketball or the big-time college sports or anything like that. But what it does have is some Major League Baseball games, NHL games, boxing, lower-level college sports. It also has Major League Soccer. It's even the official broadcast partner of Major League Soccer's Chicago Fire team, so they don't even have a local broadcast. All of their games are available just on ESPN Plus. And then also they got Italian League Soccer, which is pretty big. They have the biggest player in the world now in that league, which is Cristiano Ronaldo. They have some shows that are only available on ESPN Plus. A show where Kobe Bryant breaks down basketball, Peyton Manning breaks down football games. And then one of their bigger new deals was for UFC, which is the Ultimate Fighting Championship, which is combat sports growing in popularity like crazy. And they got into this a lot on their earnings call last week, because not too long ago they had their first UFC fight night under their new 5-year deal with UFC. UFC, not USC. And it's worth $1.5 billion for a 5-year deal for ESPN and ESPN Plus to broadcast these UFC fights. And they said that the first UFC fight night on ESPN Plus helped them get 600,000 fans to sign up for the service. So that is a huge, huge chunk of the people that are even on this service already. So clearly it was a good idea to get this UFC deal to encourage people to sign up for the platform, and then hopefully they'd like it and tell all their friends. I mean, that's basically the idea. And at this point, ESPN Plus now has 2 million paid subscribers, doubled in just the last 5 months. But to think that 600,000 people signed up basically just to watch that first UFC fight night, that is a massive chunk, just over a quarter of that just for that UFC fight. So that is, as I said, really good for ESPN Plus to see that their investment in UFC and combat sports is paying off. And CEO Bob Iger thinks that their investment in combat sports will continue to grow, and that'll be kind of a big part of their company going forward. He talked about that on the earnings call for a little bit. And then there's some numbers here that kind of jumped out at me that I thought were pretty interesting. They talked about on the earnings call that 49 million Americans, or 15% of the entire population, watched ESPN, the U.S. population, watched ESPN content on linear TV that day of the UFC fight night, and that they think going forward they will continue to advertise ESPN Plus at all times on their actual linear platforms to encourage more people to sign up. They're going to do the same thing with Disney Plus. It's just, you got to get it out there, because maybe there's some people at this point who don't really know anything about it. People who are listening and people who are into this can't really imagine that people don't know this whole streaming world's happening, but maybe there's a lot of people out there that need this exposure more often on linear TV for ads. So expect to see a lot more ESPN Plus and Disney Plus ads. We've already, if you're an ESPN Plus watcher or ESPN watcher, you've seen a lot of ESPN Plus ads at all times, but you'll start to see these Disney Plus ones come out soon. And then another interesting number that stood out to me on the earnings call was Bob Iger getting into just the amount of volume that ESPN Plus was getting. They said they had 600,000 people sign up in a day. There's a lot of back-end fulfillment requirements that go into that. So he talked about how successful BAM Tech, which is the platform they bought, that's going to really help them roll out Disney Plus and ESPN Plus in the future of their streaming business. He said they easily handled the volume, which was more than 500,000 people signing up in that single 24-hour period. They were making just under 15,000 transactions a minute, which just sounds crazy. So it's good to see that it's an effective platform so far for them. Now I kind of want to close and wrap up the end of the episode by diving into a little bit of ESPN's future and Disney's future with ESPN Plus and all of that. So we'll see this. You can see down the line that ESPN Plus, or whatever it's called in the future, if it's just ESPN, in years or decades, will be able to be purchased where everything that ESPN owns, you'll get to watch, not tethered to a cable subscription. That's not going to happen anytime soon. Because they have deals in place, and even the next round of deals with the NBA and the NFL and college basketball and football, they're not going to allow them to just say someone can watch this only in stream. The cable, it's not happening yet, but eventually someone's going to be able to purchase ESPN and not have a cable package whatsoever, and then watch everything that ESPN has to offer. So pay attention to that going forward, because that's definitely where it's going. Another interesting thing to notice, and it's something that Disney's talked about before, is that you'd think with ESPN Plus and Disney Plus and Hulu that they might offer some type of streaming package bundle to entice more users in this ever more crowded streaming market, but it doesn't seem like they're going to do that. Certainly not anytime soon, or at least that's not their plan now. Bob Iger and executives basically said their strategy is to have 3 separate ones, but it'll be easy where you can kind of have the same login credentials. It'll be on the same credit card. They'll make it easy for you, but you're going to have to pay for all 3 services, is pretty much what they're saying. There is no discount for now at this point. And it's unclear exactly how much Disney Plus is going to cost. So we'll see what happens there. And then one of the last things that they really focused on the ESPN Plus side in terms of the earnings call was one of the analysts asked Bob Iger if Disney has any plans to get into sports gambling, because as we've talked about on the show, sports gambling is quickly becoming legalized on a state-by-state basis. And they were saying, like, you have UFC now. Are you going to get into sports gambling? They were talking about how some of their content that they're buying from Fox is a little more edgy, especially with FX as well, that it's not necessarily as family-friendly as the overall Disney brand. And Bob Iger basically said they don't have any plans to do it for now, which means they will do it as soon as they can make a bunch of money off it at some point. And he did note that ESPN does write about it. They do talk about it. It's not like it's a taboo topic completely at ESPN, but it's not like they don't really have any big plans to make a huge push into sports betting anytime soon. But it's certainly not something they're shying away from in terms of content across their platforms. They're obviously talking about sports gambling more than they ever have because it's legal in way more places than it ever has been. As we know at this point, all 4 major North American professional sports leagues have partnered with a casino. The NFL was the last one. They partnered with Caesars. The NBA, Major League Baseball, and the NHL have all partnered with MGM. So this is a quickly expanding world, and then ESPN and Disney are clearly going to take advantage of any revenue opportunities down the line that present themselves in terms of sports gambling. So as I mentioned, ESPN Plus and Disney Plus will be really fun to kind of watch grow, especially this Disney Plus, which we don't really know what it's going to look like, but we're going to have more clarity there within the next few months. And as this decentralized entertainment market expands quickly, with everyone from YouTube and Facebook and Twitter all trying to get in the action, it's going to be an interesting marketplace to watch because, as my producer Danny and I have talked, there's now just going to be so many options in so many different services that you're really going to have to start budgeting around what your cost structure is going to be when you're now trying to pay for Netflix, Amazon Prime, HBO, ESPN Plus, Disney Plus, Hulu. I mean, it's gonna get a little bit out of control. Apple's rolling out their service soon, so it'll be fun, and we'll have a lot to talk about on this show for years to come about this. And I quickly want to end with just a little bit of Disney's outlook in terms of their top and bottom line, just to give a little bit of perspective. So their current quarter revenues are supposed to climb just over 1.1%. And then their full year revenues are supposed to climb about 1.8% to $60.5 billion. And that's based on our current Zacks consensus estimates. And then on the bottom line, our estimates are calling for about 1.6% earnings per share growth this quarter, and then actually for the full year, they're calling for about 1% decline in earnings, which is most likely attributed to just the amount of money they're spending on this Disney Plus and ESPN Plus rollout. And I also want to just quickly talk about or mention Disney's stock price movement over the last 5 years because it helps put things into perspective. Disney shares are up around 43% since 2014, which falls below the S&P 500, which is at about 55%. And there's obviously been some fluctuation, but they're doing all right. And then within the last year, Disney is actually outperforming the market. They're up. Their stock price was up around 9% over the last year, which has outpaced the S&P 500's roughly 6% climb. So doing pretty solid. Anytime you outpace an index, that is good. And they're really now in it for the long haul of this complete transformation of their business model in terms of streaming. And obviously, studio entertainment is going to be a big part of it going forward, but it'll be really exciting, as I've said, to watch the growth of ESPN Plus and what they do with Disney Plus and how they handle their majority ownership of Hulu going forward. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.